Hi everyone, welcome to Slow and Steady. In this video, we are going to see about law of diminishing marginal utility. This is one of the fundamental and most basic concept in economics, as most in not most, but at least in microeconomics, the further topics will be almost relatable to this law. So please kindly engage yourself throughout this video to get to know the concept clearly. In this video, we are going to see an overview of what is meant by and why do we do consumption analysis, and then about cardinal utility. What is cardinal utility? The reason why we see this is that cardinal utility is an approach used in consumption analysis under which we have law of DMU. About this we will be seeing clearly in the later part of this video. So moving on to introduction. To introduce the consumption analysis, the first question here is who is a consumer? Of course, we have a lot of definition in commerce, marketing, and some other related field. But in economics, it is very simple that a consumer is a person who buys goods and services. With this definition, you can get to know that almost everyone in this world is a consumer. You, me, and everyone, right? So why do we all consume? Of course, we all consume to satisfy our own want. Wants here means your desire. Your desire to go for a road trip, go for a movie, go for a lunch, or go for a cup of coffee or something. Lot of right. We can't put it in them in words. So do you think that all your wants are getting satisfied? Don't you have any unsatisfied wants or something? Of course, everyone is having, like, we do have like a bucket list, right? In that bucket list also we have something of priorities. First one, we need to do this, and second, I need to do this, and third. So every one of us have some bucket list and some priorities. So that why that? Because we have some restrictions and criterias that affect our wants. Maybe your mom will not be leaving you to do a particular work, or you won't have enough time to do that, or the situation will not be favorable. So we have lot of restriction, kind of like this. In economics, what we do is we put those restrictions and criterias into three main determinants of your consumption. Okay, uh, in of course not only these three, but we have a lot of other, but in economics we consider only these three because this is the matter of interest for economics. Okay, so here we have price, taste, and income. So the first one is price is that if you are willing to buy a product, the price of the product should be reasonably priced. It should not be overpriced or something, otherwise you will not be buying that. Okay, so the price of the product definitely affects your consumption, right? Then taste. Taste, how it affects? Of course, you won't consume something that you don't like. You will always consume a product that you like. So taste plays a main and important role in deciding a consumption. Then last but not the least one, of course, it is income. Income means, in the sense, the price of the product is reasonably priced, you have a willingness to buy the product, but you should have enough income in your hand that should be able to pay for that product. The product should be affordable, in other words. So income plays a major role. What are these three determinants? Income, price, and taste. All these three affects your consumption pattern. In consumption analysis, we see how these three affects your consumption. Okay, this is what we are going to see in consumption analysis. Utility. What is meant by utility? Let me say first, it doesn't mean the literal meaning. What is the literal meaning of utility? It is the usefulness of the product. It doesn't mean that, okay? In economics, we have some other different meaning. To say you have eagerness or you have a craving to have a hot chocolate or something. You go buy the product and have it, you derive some amount of satisfaction. Let me say Let me make it further understandable. You have craving for hot chocolate in the morning. In the morning you need to have that, but due to some kind of situation you're not be able to do that, but you still want to have. By the evening only you manage to get that and you're consuming it. You will be getting some level of satisfaction, or you will get some level of fulfillment or mindfulness. That level of satisfaction or the fullness you get, right? That feeling, that level is called utility. Okay, here utility means the level of satisfaction you derive from consuming a product, good or service. Okay, here the famous economist Benham said that utility is a cardinal concept. What is meant by cardinal is it is measurable. So, according to Benham, utility can be measured. He gave an unit of measurement for that also. He gave utils as a measurement. So, what he says is that utility can be measured in terms of utils. For example, you are having two chocolates. You derive some 10 utils from that. I mean, 10 level of satisfaction. That 10 is called utils here, okay? But what happened? Marshall came in and he redefined this approach. He said that utility can be measurable, but not in the terms of utils. We can use money to measure utility. But how can we use money to measure utility? Of course, it is not the price of the product, okay? The money doesn't mean the price of the product. There is always something different in the word price and the price you are willing to pay. For example, there are two brands, Dairy Milk and Kit Kat. Okay, you want to have chocolate, but you like Kit Kat more. Okay, now what happens? The price of the dairy milk is 50 rupees, but you don't want to pay 50 rupees. You are willing to pay only 10 because it at least gives you a feel of chocolate, but you don't like that. For other hand, you have Kit Kat. That product is priced some 10 rupees, but you want to have it, so you are willing to pay like amount 50 rupees for that Kit Kat. So you see there is a difference in that price and the price you are willing to pay. That difference, what Marshall says is that we can use the money you are willing to pay for the product. So according to Marshall, the Kit Kat have utility of rupees 50 and Dairy Milk have utility of rupees 10, but the market price is something different, right? So this is what Marshall said. Then coming to the point, we have two different terms here. One is total utility and other one is marginal utility. Total utility is nothing but it is the sum of all the utilities you derive. For example, I'm giving you 5 chocolates, okay? You're having all those 5 chocolates. Here, total utility means it is the utility derived from all those 5 chocolates. For example, from the first product you are deriving some 50 units of utility. Second unit you are deriving 40. Third unit you are deriving 30. And the fourth unit you are deriving 20. And the fifth unit of the chocolate which I gave you gives you an utility of 10. So if basically total utility is the sum of all these 5. Here in this example we have 50 plus 40 plus 30 plus 20 plus 10. So it gives you like 150 units of utility you derive from consuming all those 5 chocolate. This is mean total utility. Then marginal utility. Marginal utility is nothing but it is the addition made to the total utility. For example, you consumed 5 units of chocolate. Now I am giving you another unit of chocolate, 6th one. So basically, marginal utility here means from first 5 you derive 150 units, right? So after consuming a 60 unit of chocolate, your total utility became 155. Now say what is the utility you derive from 60 unit alone? Yes, of course. It is 155 minus 150. You will be having like 5 units of utility from that 60 unit of chocolate, right? So marginal utility is nothing but it is the utility you derive from consuming that particular unit of chocolate. For example, let me see. You are consuming 6 units of chocolate, right? First unit it's 50, second units you derive 40, third unit you are deriving like 30 units of utility. That 30 unit of utility is the marginal utility you derive from third unit alone. Leave out the first two you consumed and the rest three you are going to consume. I'm here to give you other three also. So utility derived from that particular unit of consumption is called marginal utility. Then, yeah, we have some certain assumptions. With these assumptions only we can do cardinal analysis, cardinal utility approach analysis to consumption. So what are these assumptions is that first one, utility can be measurable. Of course, the word cardinal itself means measurable. If you can't measure your utility, we can't do cardinal way of analysis, right? That too it should be measurable in terms of money, as according to our master said. Then second one is consumer's income is given. You should know the income in your hand that you can spend or something. So consumption purpose, your income must be known to you. Then third one, price of the commodities are given and remain constant. Of course, the price should know of the commodities you take, right? That should be constant. For example, I'm giving you 6 units of chocolate. The price of all the 6 units of chocolate should be same. It should not be any fluctuation. Like first one is priced as 10, second one priced at 20, sixth one priced as 10. So there should not be any fluctuation or any changes. Basically, any changes in the price during your consumption process. This is what the third assumption means. And the fourth assumption is constant marginal utility of money. Like all other goods and services, money is also good, right? So for money also we have some marginal utility and total utility concepts. Here in this cardinal analysis, we assume that the marginal utility of money is constant. Then, now we are going to see about law of diminishing marginal utility. What this law basically states is that if you I'm giving you chocolates, right, one by one I'm giving you, what happens is that according to this law, the marginal utility you derive from the extra unit of the chocolate I'm giving you. For the first unit, you will be having some 50 units of utility. If I give you second one, what happens is you got some level of satisfaction in the first unit itself, okay? But you still have second one. But the utility you derive from second one will not be as same as the first one, right? That is what this marginal utility is, law of marginal utility is basically trying to explain here. uh, if I am giving you I mean each and every chocolate, your marginal utility will be keep on diminishing. Okay, this is what this law states. With every increase in the unit you consume, your marginal utility will be diminishing. So simple, right? For example, I'm giving you first one, you derive some 50 units. For the second unit, what will have you derive some satisfaction, so the utility will be something lesser than the first one. For the third unit, what will it will be lesser than the second one, and fourth unit it will be lesser than the third one. To put it in numbers, for first one you will be deriving some 50, second one it is like 40, third one it is like 30, and fourth one it is like 20, and fifth one ultimately your marginal utility will be so low as just 10 utilities you will be getting, right? So what happens is, at certain point your marginal utility will become zero. Of course it is keep on diminishing. At a certain point it should reach zero, right? I'm giving you one more, one more. I'm not stopping the process of giving you the chocolate. But what happens, at some point your marginal utility becomes zero. For example, you already had 5 chocolates, now I am giving you another unit of the chocolate. So what happened? The 60th unit of the chocolate will not have any level of satisfaction. It will not bring any level of satisfaction to you. So the marginal utility from the 60th unit of the chocolate will be like zero. You don't want to have, but yet you consume it because it is neutral. It does not going to add up your satisfaction, or it is going to decrease your satisfaction. That's 60th unit. Now I'm not stopping at that stage. I'm giving it another 1/7 unit of the chocolate to you. What happens now is you don't want to have chocolates. You just started hating, or you are like, I don't want to have a chocolate. You are at that mindset, okay? So now what happens is the 7th unit of the chocolate will have some negative marginal utility. Of course, after zero, the number should be negative, right? So it has some negative unit of marginal utility that we call as dissatisfaction, because it is decreasing your satisfaction level from the previous consumption. Then we do have some assumption for this law also, because if these assumptions are not working, your law will not work. It will not be acceptable or reasonable. Okay, so the first one is the standard unit of measurement. Yeah, you should measure the utility from all those seven units of chocolate in the same unit. For example, we have now money. With in terms of money, we measure all the 7 units of chocolate. There should not be any difference in the measuring term. Then second one, homogeneous commodity. Homogeneous commodity means I'm giving you 7 chocolates. All those 7 chocolates should be identical in all aspects. There should not be any visual differences like in taste or size or something. Okay. Then third one is continuous consumption. Yeah, you should be able to consume it continuously. There should not be any break. Your consumption process should be consistent. Okay, that is what this third assumption mean. And fourth one is, of course, your mental and social condition should be normal. It should not be any abnormal or something case. Okay, then relationship between total utility and marginal utility curves. Basically, the law of DMU explains all about this relationship. Okay, so you can see this in this graph. You can see that what is the total utility at the beginning. It is starting from the origin, because if you don't consume anything, you will not have any amount of utility, right? So it is starting from zero. With increase in the quantity you consume, with the increase in the units of chocolate I'm giving you, your total utility is decreasing, I mean increasing. You can see that your total utility is increasing, but this curve is like somewhat concave, right? This concaveness of the curve says that what, your total utility is increasing but at the diminishing rate. Okay, why is that so? Because your marginal utility is keep on decreasing with the increase in the chocolates I'm giving you, right? So your total utility is increasing but in the decreasing rate. After some point, that 60th unit of the chocolate I'm giving you will give you that zero marginal utility, right? At that point, what will be your total utility? It will be maximum, because beyond that you cannot increase your total utility. That is the maximum level of utility you can attain with this consumption process. Okay, that point we call as saturation point. And after that 60th unit of chocolate, what happens to the 7th and 8th unit of your chocolate? It becomes negative, right? -10 and -20. That point, that part, your total utility will be decreasing. Okay, so to put it in simple words, when your marginal utility is decreasing in the positive side of the graph, your total utility will be increasing at a decreasing rate. When your marginal utility is zero, your total utility will be maximum. When your marginal utility falls into the negative side of the graph, like I said, in the dissatisfaction, negative marginal utility, that part, your total utility will be decreasing. This is the relationship between total utility and the marginal utility. Okay. let's finish here. If you have any further doubts in this concept or anything related to your economics, we have a form in the description. You can fill that so that you will be able to get a live interactive online doubt clearance or doubt solving session with us. Thank you. You can also join us in our Telegram channel that is also available in the description below. Thank you.